Hi, I'm Nathaniel Eckman. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and, finally, answer your questions. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and, therefore, has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve cut the federal funds rate by a quarter point to 4.5 to 4.75% at its November Federal Open Market Committee, or FOMC, meeting. It marked the second reduction this year, and all indications are that the Fed will implement another 25 basis point decrease at the final meeting of 2024, which commences on December 17th. Federal Reserve Chairman Jerome Powell said that the central bank will continue assessing data to determine the pace and destination of interest rates. Recent data have given the Federal Reserve a green light to continue on its less restrictive monetary policy course. The October Consumer Price Index, or CPI, rose 0.2% month to month and was up 2.6% over the last year, showing a slight uptick in the headline figure. The core CPI, which excludes the more volatile food and energy components, rose 0.3% and 3.3% respectively, matching the consensus forecasts and the prior month's readings. Meantime, the October jobs creation figure at an estimated 12,000 was dismal, but that tally was likely negatively impacted by two hurricanes this fall and a few notable workers' strikes. Investors also should note that initial weekly jobless claims remain at a low level. Still, the headline October jobs creation figure likely pushed any possibility of a Fed pause on the interest rate front into 2025. Third quarter earnings season was another successful 3 months for corporate America. As we went to press, profit growth for the S&P 500 companies was averaging around 5%. This would mark the fifth straight quarter of year-over-year earnings growth for the S&P 500 companies and was likely needed to justify the index's elevated price-to-earnings multiple. The stock market reacted positively to the recent U.S. election results, with President-elect Trump's promise to maintain or lower the corporate tax rate and reduce the Biden administration's regulations, particularly in the banking and energy sectors, seen as positives for corporations. We shall see how successful the incoming Trump administration is in implementing these plans, but with the transition moving quickly on filling some top jobs, and with likely Republican control of both chambers of Congress, advances on pro-business initiatives may be fairly swift. In conclusion, the U.S. stock market surged to a record high following the presidential election, with broader sector participation. With sentiment in place that the Fed will continue loosening monetary policy next month, the stage may be set for another late-year Santa Claus rally. In this environment, we think a portfolio led by equities is warranted. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading. On that note, ValueLine provides a great deal of information and analysis to our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website, which once again is www.valueline.com. I will now show you how to access these supplementary reports. Once you're signed in on the website, head to the dashboard, where I am already located. This is the main landing page for subscribers. Under the Quick Links section, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, ValueLine has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, which is another proprietary ValueLine measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information with regards to our proprietary ranks and ratings, ValueLine provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong right now over broad index funds. Now, let's move on to our one stock to buy right now. For this, let's go first to the screener. ValueLine subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but that they require a higher level of subscription. If that interests you, please call 1-800-ValueLine. As noted in our economic commentary, the stock market is currently soaring on the combination of loosening monetary policy and the prospect of pro-business policies from the new presidential administration and Congress. Accordingly, today we're going to be looking for a stock with strong near-term prospects that's positioned to ride that wave of investor enthusiasm going forward. Today, we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that while stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which once again is available free of charge in the investment education section of the website. Today, we're going to focus on stocks with a safety rank of 3 or better. And by applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 2,180 candidates. Next, we're going to filter for timeliness. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format, once again, is the same easy-to-understand 1 to 5 scale, with 1 being the best performing on a relative basis. Most often, stock buyers will want to avoid stocks ranked 4 or 5, while stocks ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better. And applying that filter, we are now down to 359 candidates. Value Line not only tracks the timeliness of individual stocks, but also entire industries. Since our focus today is on year-ahead relative price performance, we can actually double up on that by focusing on timely stocks in timely industries. Today, we're going to look at companies in the top 10 industries out of the 100 that Value Line tracks. By doing so, we reduce our list to 78 candidates. Today, we're not looking for value stocks, but rather for strong issues that are trending upwards based on the current developments in the market. To capture that, we're going to look for stocks that are currently trading within 5% of their 52-week high price. And so, applying that filter, we are now down to 32 candidates. Finally, while timeliness measures relative price performance, we still want to have some sort of measure for absolute price performance in the screen, and for that we're going to use the 18-month target price range. Since our main focus today is on year-ahead performance rather than the intermediate 18-month term, we don't have to be too strict. We'll be filtering for stocks with an appreciation potential of 10% or better to the midpoint of their 18-month TPRs. By applying this screen, we've chipped away the list of prospective candidates down to our final 15 prospects. And those are Amphenol Corp., ticker APH, Casey's General Stores, Inc., ticker CASY, CSG Systems International, Inc., ticker CSGS, Cintas Corp., ticker CTAS, Cognizant Technology Solutions Corp., ticker CTSH, Deckers Outdoor, ticker DECK, Empire Company Limited, ticker EMPA on the Toronto Stock Exchange, Comfort Systems USA, ticker FIX, Front Door Inc., ticker FTDR, CGI Inc., ticker GIBA on the Toronto Stock Exchange once again, WW Granger Inc., ticker GWW, Hubble Inc., ticker HBB, Paychex Inc., ticker PAYX, Westco International Inc., ticker WCC, and Wipro Limited, ticker WIT. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Cintas Corp. Before I click on Cintas, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top of the page. Now, let's move on to our report on Cintas. Cintas offers a variety of business services, primarily uniform rental and facilities services, though first aid and safety services have become an increasingly important part of its portfolio over the last several years. It operates mostly in the United States, though it does have operations in Canada and Latin America as well. As the page, which has just come up, shows, the stock is timely, and we think that its current strategy positions it well to continue to perform going forward. Notably, Cintas has a large domestic footprint, and though it does source some products internationally, it has the flexibility to change the particular sources of supply in that regard. In fact, increased onshoring of manufacturing may actually help boost demand for the company's services. Thus, Cintas is in a good place to benefit from the pro-business and protectionist policies we expect to see from the new administration, while avoiding the brunt of the negative impact of proposed tariffs. Overall, we think that Cintas is a strong, momentum-oriented pick. It is today's one stock to buy right now. We will now tackle your questions. Please note, we typically can't answer complex questions about specific stocks on the spot. For that, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand things off to Alan and Charles.
Daniel, I'm Alan. There's a couple interesting questions that came in. Someone asked, I was interested in knowing what the three figures in the bottom right of the value line page mean. Earnings predictability, stock price stability, and price growth persistence, which are right down here in the bottom right underneath the financial strength. Earnings predictability is a measure of the reliability of an earnings forecast. Predictability is based upon the stability of year-to-year comparisons, with recent years being weighted more heavily than earlier ones. The earnings stability is derived from the standard deviation of percentage changes in quarterly earnings over an 8-year period. The most reliable forecasts tend to be those with the highest rating, 100, and the least reliable, the lowest, which is 5. The price stability rating is a relative ranking of the standard deviation of weekly percentage changes in the price of a stock over the past 5 years. The ranks go from 100 for the most stable to 5 for the least stable. Finally, the price growth persistence is a measurement of the historic tendency of a stock to show persistent price growth compared to the average stock. Value line persistence ranges from 100, highest, to 5, which is the lowest. There was also a question regarding Cintas's business segments, to go into a little more detail about its business segments. Cintas reportable operating segments are the uniform rental and facility services operating segment and the first aid and safety services operating segment. The uniform rental and facility services reportable operating segment consists of the rental and servicing of uniforms and other garments, including flame-resistant clothing, mats, mops, and shop towels, and other ancillary items. In addition to these rental items, restroom cleaning services and supplies, and the sale of items from our catalogs and customers en route are included within this reportable segment. The first aid and safety services reportable segment consists of first aid, safety products, and services. The remainder of Cintas's businesses consists of the fire protection services operating segment and the uniform direct sale operating segment, which is included in all other on the operating statements. Thank you.
I've got another question about Cintas here. Specifically, I'm being asked to elaborate how will this stock be affected by the president-elect's proposed economic and other programs, including the tariffs, which I mentioned earlier. And so part of the reason why we selected Cintas specifically is that its market and supplies are very well concentrated within the United States. So while certain components of uniforms may come from China or elsewhere abroad and thus be subject to tariffs, more of the firm's value add is derived from the domestic services provided by workers residing here in the U.S. Likewise, the workers that the company clothes are based here in the U.S. They're generally very stable in their positions. Some of them are unionized. And so another plus there is that Cintas has relatively little potential for offshoring its assets or profits because, again, very concentrated in the U.S. So the fact that it'll be able to count on a corporate tax rate that will, at the very least, not go up at January 1st, 2026, when the current tax breaks expire, and which might in fact even come down, is a very big plus for this company specifically. So that was some of our thinking as to why this specific stock at this specific time. I've got another question. How does the online version of the investment survey differ from the library version, specifically with regards to data? So the page that you're seeing here this is exactly the same page that goes into our print version. Some of the other stuff that you saw earlier, such as the screener and the digital page that we briefly scrolled through before pulling up this print similar page. Those are obviously going to be online exclusive because we do not have the means to print a self-updating page or screener. We would if we could. But so because of that, the data in the online version is going to be a little bit more current because things like the price and certain other metrics are getting updated on a rolling basis on the online version, whereas the print pages are only updated once per cycle. So the main difference...
Charlie here.
Hello, Charlie.
Yeah. Oh, I'm sorry. I thought you were finished there, Nate, regarding the...
yeah, I was pretty wrapped up. Go ahead.
No, I just received a question regarding the price earnings multiple and how that factors into our considerations for one stock to figure right now. We have no formal constraint in terms of valuation. You can see when we go through the filters, there are options for certain PE multiple constraints that you can select, but when we go about selecting a stock, there's no formal constraint that we impose. That said, as of the most recent week, the median PE ratio for all the stocks in our universe is 18.9, which is historically very, very high. And I think for next year, earnings for the S&P 500 as a whole are around $275 per share, making 2025 earnings multiple around 21, 22 times, depending on whose estimate you use. And again, that is relatively high on a historical basis. However, when we do make these selections, we do not have, well, although we are mindful of valuation, obviously we do not have any formal constraint.
Mm-hmm.
Hey, thank you. I think that's all the questions. Well, thank you all for joining us. We'll now hand it back to our producer, Peter.
Thank you, everyone, and thank you to our remote attendees for joining today's session. This does conclude today's session. Feel free to disconnect your lines and enjoy the rest of your day.